Welcome back to the Deep Dive. Today, we are just cutting straight through the noise. We're going right into the Q3 2025 financial results for Monster Beverage Corporation.
And specifically, we're zeroing in on that detailed snapshot from the chief financial officer.
Exactly, that 30,000-foot view of their performance drivers, profitability, and what they're betting on for 2026. Okay, let's unpack this.
Well, our mission here is really to distill the core figures and explain what they actually mean. This wasn't just a good quarter. The CFO's remarks, they really underscore an exceptionally strong, efficient quarter.
They hit multiple records.
Multiple records. It signals a fundamental strength that goes way beyond just, simple top-line growth.
And that efficiency, that is the headline we have to start with.
Yeah.
I mean, the biggest revelation here is that the percentage growth rates for all their key profit metrics.
Gross profit, operating income.
Right, net income, EPS, all of them actually outpaced the growth rate in net sales. Net sales grew, sure, but their profit grew significantly faster.
And that is the single most important takeaway for you. It means the company isn't just relying on selling more cans. They are mastering pricing, controlling their costs, and they're benefiting from a consumer shift toward their higher margin products.
It's a textbook case of leveraging scale.
Absolutely. Leveraging scale to just drain more money to the bottom line.
Okay, so let's start with that top line, the big number. Reported net sales hit $2.2 billion.
And for context, that's a 16.8% increase over the same quarter last year.
That is some serious growth momentum.
It is, but, we always have to look at the foreign exchange reality. Favorable currency rates gave them a nice tailwind, about $31.8 million in sales.
Okay, so if you strip that out.
Even if you strip that currency benefit out, their FX-adjusted net sales still increased by 15.1%. So the underlying growth engine is just running hot.
If we look at the core business, so net sales without that pretty small alcohol brand segment, the growth was even stronger. It was up 17.5%.
And that tells you where the focus really should be. I mean, the profitability jump is just staggering. Operating income increased 40.7%.
40%.
To $675.4 million. And EPS, or net income per diluted share, that shot up 41.1% to 53 cents.
That gap, that disparity between 16% sales growth and over 40% operating income growth, that's what validates their whole strategy right now.
It really does. So looking at the segments, the Monster Energy Drinks segment did most of the heavy lifting. It was up 17.7% to just over $2 billion.
And the strategic brands grew well, too, at almost 16%.
But here's the wrinkle you mentioned earlier, the alcohol brand segment. It decreased by 17%.
Yeah, down to about $33 million.
So given the spectacular growth basically everywhere else, is that drop a strategic drag? Or is it at least, a significant underperformance they need to fix?
That's a fair question. I mean, $33 million is obviously a tiny piece of a $2.2 billion pie. But the consistent underperformance, it does raise a strategic flag. It suggests that while they are globally dominant in energy, diversifying into these adjacent categories is proving way more difficult than maybe they expected.
More capital intensive, I'd imagine.
For sure. For now, the core energy business is just generating so much velocity, it kind of masks any issues in that smaller segment.
Okay, so now let's get into the mechanics of that profit acceleration. Gross profit as a percentage of net sales reached 55.7%.
Wait, 55.7%. That's up from 53.2 last year. That's a 250 basis point margin expansion in a single year. That's incredible in this environment.
It's incredible, and when margins jump like that, we have to know why. The CFO gave three main drivers. First, pricing actions. They just charged more.
Simple enough.
Second, supply chain optimization. They got cheaper at making and moving product. And third, a favorable product sales mix.
And that favorable sales mix is the real insight into consumer behavior, right? That has to mean people are moving toward the higher margin products like the zero sugar stuff.
Exactly. The Ultraline isn't just a hit. It's a profit machine.
Right.
But it wasn't all smooth sailing. That margin gain was partially offset by some pretty big headwinds. They mentioned higher promotional allowances, the geographical sales mix, and critically increased aluminum can costs.
Okay, can we pause there? The CFO specifically mentioned the dynamic tariff landscape and the rising Midwest premium for aluminum. For anyone who doesn't track commodities, what exactly is the Midwest premium and why does it matter to Monster?
That's a great question, because it sounds like jargon, but it is a very real cost. The Midwest premium is basically the surcharge you pay on top of the global price for aluminum. It reflects the cost of shipping, warehousing, and crucially, tariffs and trade policy right here in North America.
So since they use aluminum cans for everything.
For almost everything. So any
Yeah.
rise in that premium directly hits their raw material costs. The fact they were able to expand margins by 250 basis points despite these volatile costs is, well, it's remarkable.
It really just underscores their operational efficiency. And speaking of that, their operating expenses as a percentage of sales dropped to 25% from almost 28% last year.
They're getting leaner. It shows their strategic decisions, likely around what's called revenue growth management or RGM, really paid off.
And RGM, for you listening, isn't just about raising the price tag.
No, it's a whole philosophy. It's analyzing every channel, every package size, every promotion to maximize how much profit you make per unit sold. It's about being efficient, not just big.
And that efficiency seems to be global. So let's look at where they're selling all this stuff. How's the international footprint?
The international story might be the most exciting part of this deep dive. The CFO noted the global energy drink category is still robust. Household penetration is increasing worldwide.
It's a maturing market that's still finding new customers.
Yeah.
And Monster is capitalizing. They set a record. Net sales to customers outside the U.S. rose to about 43% of total sales.
43%.
43%.
That number just highlights the incredible success of their global expansion. Total international sales were up 23.3% reported.
Which is still over 19% when you adjust for currency. That's way higher than their domestic growth.
It is. And what's fascinating isn't just the volume, but the profitability. The CFO confirmed that gross profit as a percentage of sales increased in all three international regions.
EMEA, APAC, and Latin America. All of them.
That detail is so critical. It shows the operational improvements, the pricing, the supply chain work. It's being executed across their entire global footprint. It's not just a U.S. success story.
It's a system-wide win. So let's look at the home field then, the U.S. and Canada. North American net sales increased 11.6%.
And that growth was clearly driven by strong execution and the continued strength of the Monster Energy Ultra family.
The Ultra family is the undisputed star right now.
Without a doubt. Nielsen data showed the Ultra brand family grew 29% year over year, and it was led by that flagship White Ultra Zero.
It just reflects that huge consumer shift away from sugary drinks. It validates their early bet on zero sugar.
And they are cementing this by being proactive on price. They announced pricing adjustments, which could be price hikes or just fewer promotions, effective November 1st.
This is a classic RGM move, right? Timing the increase to minimize friction.
Exactly. And they expect minimal impact on volume. And the reason they're so confident comes back to that core theme, the value proposition.
Right. They argue that energy drinks still feel like a good deal compared to other ready-to-drink beverages.
Specifically compared to the coffeehouse industry. As you know, discretionary spending gets tighter. They're betting people will trade down from that expensive daily latte into their category.
Which gives them the confidence to pull the pricing lever without worrying about losing their whole customer base. It's a really interesting strategic anchor.
It is, and they aren't just sitting on that success. The innovation pipeline is absolutely stacked.
Giving us a sneak peek into their 2026 strategy. And we know they rolled out some successful new products in 2025, like Ultra Wild Passion, and that limited time Lando Norris Zero Sugar.
But 2026 is where the big strategic bets are. That Lando Norris Zero Sugar is getting a nationwide U.S. launch in the first quarter, building on that massive success they had in Europe.
And they're launching entirely new brands. Let's talk about Flirt. That sounds like a radical departure.
It is. Flirt is planned for select channels, and it's explicitly described as a zero-sugar, female-focused brand. The initial flavors are strawberry fling and guava lava.
It's a clear attempt to capture a demographic that has been traditionally underserved by that high-octane masculine branding of the core Monster line.
And it shows they learned a lesson from the alcohol segment. Diversification has to target specific high-growth needs, and it has to be zero sugar. Flirt is tackling the white space.
They're also hitting the wellness angle. They're planning to launch Storm Energy in the second quarter of 2026.
Aimed squarely at the wellness zero sugar segment. And then you have 2 commemorative limited-time offers for America's 250th anniversary.
So, lifestyle, wellness, and patriotism, all in 2026. It's an aggressive, multi-pronged strategy. The commitment to zero sugar across all of them is undeniable.
So let's go back to those international regions, especially the high-growth areas. In EM, that's Europe, Middle East, and Africa sales, were up over 30% reported. 23% currency neutral.
That 23% is incredibly strong for a mature market like Europe. And they had a huge success story there. That Lando Norris Zero Sugar was their most successful new product launch ever in the region.
And they became the #1 energy drink in Greece.
A huge milestone. But the Asia-Pacific region, APAC, was even stronger in terms of pure growth. Sales up almost 29%.
But the real story is when you dig into the individual markets, the numbers are just staggering.
Give us the numbers.
India was up 58.6% currency neutral, and China was up 42.0% currency neutral.
Wow. Those are two of the largest, most important consumer markets in the world, showing explosive growth. That's a huge indicator of their future runway.
Now, Latin America grew a bit slower at 9.3%, but Mexico was a standout, up over 30%.
Exactly. But Mexico is also where we see an emerging challenge. Regulatory shifts. The country just approved new excise taxes on sugar and artificially sweetened drinks.
And that's effective January 2026. This is a potential headwind, right? It could impact that value proposition we talked about.
It could, but it also validates their intense focus on zero sugar products, since those will be shielded from the sugar part of the tax.
Yeah.
It shows why that RGM strategy is so important.
And finally, let's clarify that fascinating move in Argentina. The CFO said net sales decreased 15%, currency neutral, yet volumes actually increased.
Wait, so they purposefully took a revenue hit to gain what?
That's the Argentina paradox. It's a brilliant move to manage foreign exchange risk. Because of the currency volatility there, they shifted their operating model. It results in temporarily lower reported sales, but it gives them long-term stability.
They're prioritizing volume and stability over a short-term sales number.
That's smart.
It's very smart. And the final data point they offered was really encouraging. October sales estimates show FX-adjusted sales were up about 13% over last year.
Which strongly suggests this momentum is just continuing right into the fourth quarter.
It does.
So what does this all mean for you? The overarching conclusion is clear. Monster Beverage delivered a historically efficient quarter. Profitability just soared way beyond sales growth, driven by innovation in zero sugar and that explosive international expansion.
It fundamentally reaffirms that the energy drink category is seen globally as an affordable luxury.
Yeah.
That is a powerful position to be in right now. Their success in expanding margins signals operational mastery and that consumers are enthusiastically adopting their higher-margin products, like the Ultra family. Which leaves us with this final provocative thought for you to consider. Monster is betting heavily on innovation for 2026, launching female-focused brands like Flirt, wellness brands like Storm Energy. Given their ability to execute on Ultra and their aggressive pricing strategy, will this push into lifestyle and demographic targeting let them absorb inevitable headwinds like that New Mexico tax and maintain this breakneck profit growth? Or does it risk spreading the company too thin? That is the balance they have to strike going forward.